Hello to everyone. Today I am here with Risk and Return Financial Management Part 2. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this section, we are going to discuss the calculation of expected return, calculation of standard deviation, risk evaluation by applying standard deviation, risk evaluation by applying coefficient of variance, risk evaluation of portfolio by applying the different measures. Now, first of all, we are going to calculate the expected loss. In the previous slide, we have a table that includes the possible returns on different type of investment that include the tradables, pharma, food and steel according to the different economic occurrences. For example, in first economic occurrences, the probability is 15%. So we are going to multiply the rate with 15. Second occurrence comes 22%. So we are going to multiply the return with 20%. And in the third case, we have a similar return that will be multiplied by probability of 30%, and thereafter in fourth case return is same and it will be multiplied by 20%. In the last case again the return is same and it's multiplied by 15%. Because treasury bills having the no impact of any type of economic occurrence, so the return range remains the same, that is 22%. In case of a pharma, in during the boom, the probability of boom is 15% and it will be multiplied by 25. And for the above average, probability is 20% and the return is 22% and average return is 20%. And the probability is 30%. Thereafter, below average return is 18%, probability is 20%. And in case of a recession, the return is 12% and the probability is 15%. On the base of all types of the returns and probability, the expected returns against the pharma investment comes to 19.55%. In case of a food, in the boom, return is 45%, probability is 15%, above average, return is 42%, and the probability is 20%. And in case of average, return comes to 30%, probability is 30%, average return comes to 35%, probability is 30%. Below average is 25% and probability is 20%, and in case of a recession, it's 8% and probability is 15%. The total expected return against food investment comes to 31.85%. Thereafter, in case of a steel, in boom, the return expected is 50%, probability is 15%. Above average return is 40%, probability is 20%, average return is 30%, and probability is also 30%. Below average return 10% and probability is 20%. And in case of a recession, the return is minus 5%, probability is 5%. And on the basis of above calculation, the return against steel sector investment comes to 25.75%. Thereafter, we have the calculation for the standard deviation. Standard deviation equals to under root of the variance. Variance comes to Ki minus K bar. K bar is the expected return. Ki is the return on each investment, power 2 multiplied by probability. I is equal to represents the number of investment. Here we have the calculation for T-bills, because in case of a T-bill, the return on investment and the expected return are same. So after calculating, the T-bill standard deviation comes to 0%. In case of a pharma, the first return is during the first economic scenario, return is 25 and it will be subtract from the expected return, that is 19.55 square multiplied by 15%. Similarly, 0.22 minus expected return skewer multiply by 20%. In this case, you are going to calculate the standard deviation. The standard deviation for farmer comes to 3.84%. Similarly, in case of a food, the first return in boom is 45%, and it will be subtracted from the expected return, that is 31.85%. You will square the difference and multiply by the probability for the boom is 15%, and in the similar way you will calculate the total standard deviation on the food sector. It comes 12.01%. Thereafter, in case of a steel, 50 minus 25.75% multiplied by 15. In the similar way, you will calculate the standard deviation on steel sector, that comes to 18.05%. You can have a screenshot of this particular slide and can calculate yourself all the figures related to the standard deviation. Here we have the risk evaluation by applying the standard deviation. Here we have for the treasury bill, the expected return comes to 22%, here 19.5%, here 31.85%, here 25.75%. These are the figures. For the treasury bills, it's 0% because treasury bills are risk-free investment. Pharma is 3.84%, food is 12.1%, and steel is 18.05%. So here we have the possible return. In case of a return, you will add the standard deviation figure. In case of a risk, you will subtract the standard deviation figure. If you can see here, it's 23.39% is the return, and it comes to 15.71%. In the similar way, you can have the variance by 12.1%, and here we have the variance by 18.01%. So we have the steel sector investment is considered the most risky investment because of the maximum variance from the expected return, except treasury bills, because these are considered to be the risk-free investment. We have the best investment in formal sector that have a minimum variance from the expected return, that is 3.84%. Other measure comes to coefficient of variance. Coefficient of variance express the risk per unit of the return by applying the ratio of the standard deviation to the mean, and can be explained as the measure of dispersion about the expected value. So we have the expected return and standard deviations are here. Coefficient variance for the T-bill is 0, and for pharma is 0.1964, for food is 37.3799, and for steel is 7010. Coefficient variance also reflecting steel highest degree of risk per unit return. So both the measures, standard deviation and coefficient of variance, calculate the steel sector as maximum risky sector. Thank you very much. See you again on the next upcoming topic related to risk and return very soon.